Welcome to Retire Smart with David Brooks. I'm Chip Maxwell. Well, David, every week is a busy week at Retire Smart, but this one is especially so. Now, before I forget, last call, friends, last call for the ABCs of Medicare workshop, May 24th, 6:30 p.m., right here in the Midwest Learning Center at Retire Smart. 402-369-7777 to register for the Medicare workshop. Don't forget about the patriotic parade and concert. Retire Smart is a major sponsor of that event. That's Saturday morning, May 27th at 10 a.m. We'll give you more details on that as it approaches. And then this week, David, you are hosting what is known as the Tax Mastermind Seminar right here in the Midwest Learning Center at Retire Smart. Tell us what's going on this week.
So this is where we bring in advisors from all over the country that want to. They have a yearning for tax knowledge, and unfortunately, our industry, as we always talk about, just doesn't teach it. And so we started putting these on a couple of years ago, and they've gotten wildly popular. And so we have I think 16 people in this one here with us. And so these guys that are running small investment houses all over the country. And they want to be able to help deliver tax planning to their clients in an efficient way. So that's what we focus on over these 3 days. We give them access to some tools they didn't have. We license them to use our proprietary software so that they can create some tax planning efficiencies for their client bases. And these become really popular. We kind of sell them out, so to speak. In other words, we can't fit anymore in the room when we do these. And it's always fun to have these folks in from all over the country and get perspective on how long they've been in the business. And we're going to have actually one of them, I'm really excited here, coming up next segment, a guest on our show who's a radio veteran and does a lot of radio himself, Gregory Rick. So I'm really excited for that.
From New Orleans, or
Yeah.
excuse me,
Nolans.
Yeah, I got to work on that. Yeah, we look forward to hearing from Gregory.
Maybe we got some
in the next
beignets for
segment.
breakfast or something. I don't know.
Oh boy, here he goes. Now, David, I was taking notes as always in our weekly team meeting, and you focused on debt from a number of directions, but the first thing you brought up was consumer debt, different from government. Government debt is usually what gets all the headlines, but consumer debt, how much is it and what does it mean for our economy?
All right, so we do get a little worried about our government debt. So let's just give a number there so that there's some perspective on the number I'll give you on consumer debt. So government debt is at $31.2 trillion and climbing, right? And so that just is mind-boggling to most people. And we're adding over $1 trillion to that number every single year. And basically that means, folks, we're adding $1 billion about every 4 hours. Okay.
It boggles the
Right.
mind.
And it's just insanity. But consumer debt, that's you and I. That's you listening to this. The debts that consumers have just crossed over in the US $17 trillion. That's over half the government debt, right? So this includes all debts, right? Mortgages, credit cards, car loans, student loans, furniture debt, consumer finance debt, any kind of debt you can have. But that is an insurmountable number. That's over $50,000 per person in the U.S.
What would a healthy number? There's always going to be some consumer debt, right? If you've got an economy that's moving and growing, but what would a healthy number be?
Well, probably around $7 to $8 trillion would be a much more manageable number,
Wow.
right?
So this is 2 or 3 times what it should be.
Yeah, because people are living beyond their means, and we've talked about that, which is why we think the economy is in trouble here, because we've run out of the free money, so to speak. Everyone got these stimulus checks, and that's what kind of carried the load for a while, and that's come to an end. And people's credit cards. So of that 17 trillion, right? Over 1.6 trillion of that is student loan debt that people have not been paying on, Chip, for 3 years. There's been a moratorium on payments, so most have not made their payments. That starts back up July 1. So now they're going to they're pinched even more because they have to start making those monthly payments. We're over 1.1 trillion on credit card debt for the first time. That just happened about 2 months ago. We went past $1 trillion in credit card debt for the first time in history, and that number jumped 17% in the last 30 days. And so it's getting scary, because who's going to pay these debts, right? How are they going to pay them? Can they even afford to make the minimum payments? And we're starting to see car loans delinquencies are up to 14% of all car
It's
loans.
starting to feel like 2008 to me. Now, that was housing as opposed to cars and other consumer purchases, but it has that same feel to it.
We're in our 26th consecutive month of negative earnings growth. In other words, inflation has been more than the wage growth.
Okay.
So the cost to live is more than you're making, right? And and we go through periods where this happens. There's always economic periods, but even you go to the great inflation era of the 80s, we never went this long, right? So it spiked for about 15 months where we had negative wage growth, and then it stopped. Well, we're now at 26th consecutive month, and so what you've had to do is you've had to spend more than you make, right? And unfortunately, for the bottom half of Americans, on average, it takes everything they bring in just to maintain, and they've even had to borrow dollars. And now we're even seeing cracks in their investments. So people are now contributing less to 401ks. We're starting to see distributions go out of 401ks. So that's a really, really bad sign for the economic activity going on. So again, I hate to say it because I'm a pretty optimistic guy, if anybody really knows me. But for a long time now, I've been pretty pessimistic on our economy. And unfortunately, I don't have any better news for you today.
On the government debt, David, I wrote a note that you mentioned that Retire Smart clients are well positioned for what the government is in negotiations, the presidential administration and the Republican leadership in Congress arguing about the debt ceiling. Are we going to raise it? Are there going to be serious budget cuts? Who knows exactly how that's going to play out? But what did you mean when you said that we have our clients well positioned no matter what happens?
Well, the last time we got into a serious battle on the debt ceiling, you got to go back about 10 years, right? And basically, we actually went past the deadline, right? If you remember, we furloughed workers. Seemingly, somehow they still got paid, though. But anyway.
It ended up being a paid vacation.
Yeah.
The
So,
so-called government shutdown.
and, of course, now you don't have any, Janet Yellen's not helping the situation. She's out there politically just calling for Armageddon on this, and it's just pandering instead of negotiating or helping people understand how
Treasury
they can fix this,
Secretary,
right?
of course, Janet
Yeah,
Yellen.
and of course the GOP, led by in the House by McCarthy, is the House Speaker, is trying to hold the Biden administration to the fire, so to speak, to cut some spending, limit government growth at 1% a year for 10 years. There's some things in there. They're not going to get everything, but they're going to get some concessions, in my opinion. But they're not. No one's going to give in until they have to. So this is going to go right down to the wire. The reason I'm saying that the problem is this means that the government's spending more money. How do they get that back, Chip?
Well, eventually it's going to come from you,
Right.
and me,
So
and the
so
taxpayers.
it comes in increased taxation, and if you try to increase taxes, which this current administration is proposing to do on several levels, while you're in an economic downturn, that can spell disaster economically, right? And so we've positioned our clients because we think the markets have a higher probability of going south right now than going north, unfortunately. But they can go well, and like I said, we position our clients to take advantage of the upside as well, but protect them from the downside, and that's simply doing what we call proactive portfolio management. And doing reviews this past week, had some clients coming in, and we're just loved how we kind of explain why the positioning is set up the way it is right now for what's coming, because most of our clients, Chip, are at or near retirement, and they don't have time to catch up. They don't have this just luxury of, oh, well, I'll just hang in there if my market counts go down 40%. I can hang in there. The markets come back. Well, yeah, but they could take 5 or 6 years like the last 2 times that happened. Most retirees don't have the luxury of waiting that long. So that's when we talk about how we position them. But we think there's going to be an amazing opportunity whenever the carnage is done. And as we talk about that as well. And at our State of the Market update, I kind of gave a precursor of this to our client base back in February, kind of explaining this is what the odds show, and it looks like it's coming, pretty much coming to fruition. So anyway, so yeah, we're ready for economic downturn because the consumer is in trouble, and that's where our economy is based. We're a consumer-based economy.
Mitigating damage during the rough patches means you have more left for when the good times eventually come back, and you can fully benefit from that. But the good times may be a long time in coming, David. The last thing you mentioned was consumer demand dropping, tapped out was the phrase you used. And actually, you sent me an article from freightwaves.com. An unusually terrible freight market may get a lot worse. Oh my goodness.
Yeah, so my nephew, I talk about sometimes, is in the trucking business, and the demand is totally different than it was just a year and a half ago. You could have named your price to move freight around. Now it's changed drastically, and we're seeing that the demand for shipments is dropping drastically, and that's because most retailers have too much inventory, so they don't need to order as many goods and services. We've talked about that in the past. Orders are dropping, but that's a telltale sign of what's coming for sales data. In fact, we had Target, one of the bigger retailers, just reported earnings this past Wednesday, and their foot traffic is down mightily, and they actually beat their earnings, just so you know, but their forecast was not rosy. They kind of gave guidance for the next year of sales growth of a positive 1% to a negative 1%. So basically no growth, right?
That's a wash. Yeah.
And they're seeing people step down within the products they're buying off their shelves. They're dropping brand names, and we see this transition. We saw it happen during the Great Recession of '08, '09, et cetera. People kind of went from Target maybe to Walmart, right? And from Walmart, step down to maybe the Dollar Tree or Dollar General. In other words, you're trying to find ways to get your dollars to stretch further. But of course, there's so many gimmicks put on by the companies that package the goods and services we buy, especially in the food arena, shrinkflation, as we call it, right? And that's very real. So people are struggling mightily, and it doesn't bode well for the future. So here's what I'm telling our listening audience: don't just take it, take action. Understand what it means if you've done the due diligence and put your portfolio and put your money hard work, money to work. Maybe it's time to at least look at a rebalance of your portfolio, or de-risk your portfolio, so that you're prepared for what may be coming.
Well, that's what the report card is all about. Complimentary report card, by the way. There's no charge, there's no obligation. We review your entire financial situation. Maybe you're in good shape. Maybe, especially in these unprecedented economic times, you need to make a few changes. Now is the time to find out. Get the complimentary report card by calling 402 369 7777. 402 369 7777. Up next, Retire Smart is hosting financial advisors from around the country this week for a tax planning seminar. We will hear from one of the participants next on Retire Smart with David Brooks. Welcome back to Retire Smart with David Brooks. I'm Chip Maxwell. Tax Mastermind. That's the name of the periodic seminar held by David Brooks to share his tax planning strategies with fellow financial advisors from around the country. One of those fellow advisors is with us now. David, please introduce our special guest.
Hey, thank you, Chip. I appreciate you introducing us. Yeah, so I've got my good friend, Gregory Ricks from Nolans. So we try to say it correctly. I'll never get it exactly right. But you and I met actually in a mastermind group. You're in this week into what we call our tax mastermind here, learning some of the tax strategies that we talk about and try to train other advisors on. But you and I met in kind of a growth mastermind, a business mastermind. Gosh, I guess a little over 5 years ago. I believe we were in Dallas, Texas, where we met, and kind of became fast friends. And you've got a thriving practice down in New Orleans. You've been in this business for a long, long time. So hey, thank you for taking a few minutes to stop into my studio this week.
Oh, it is such a pleasure to get to visit with you here, and it's been a great friendship that started
Well,
back
I,
then.
I got to tell you, for entrepreneurs listening to the show, that the biggest thing you can do is find friends that are in your business or your industry, and that are maybe in different cities. They're not your direct competitors, so that it's so easy to openly and freely get some friends and share information and feedback, so that you can do the right things for your clients, for your customers, for your employees, grow your company. And so Greg and I have been, as I mentioned, in this mastermind group together for about 5 years. That was just that. It was just helping us become better business owners, help our employees become better, help our clients get better satisfaction, better results in general in business. So anyway, I really do. I really value our friendship, and it's been a lot of fun. So,
And I
uh,
value your tax knowledge that
well,
you bring to the friendship. That is tremendous. When you can save on taxes and then get that money to compounding tax free, that is some magic.
well, isn't it amazing though? How long have you been in this industry?
Uh, 30 years.
So 30 years, so 24 for me. But most advisors I meet, and just like you when we talked about, right? Taxes were never taught to you from the industry, right? You weren't taught to talk tax, you weren't taught to plan for tax for you or your clients for that matter. And that's what I think we've done so well and done so differently, not only for our clients, but now exactly we train other advisors how to do this for their clients. And so but it's been a fun ride. So I want to though get your take, because you do radio, and in fact you do a 3 hour program on Saturdays. You do a long form radio show in your market, and so kind of you're probably like me. You like to talk about some of the topics of the day. In that first segment with Chip, you just heard me talking about some of the economic activity not looking so good. Right, we're seeing freight, truckers. It's fallen off a cliff. The demand for filling up trucks, and actually my nephew, who's a business partner of mine in one respect. he runs a trucking company, and he does what's called the less than full loads, so they pick up
Yep.
partial stuff. And a year ago he could have named his price to move freight. Today you got to, please give me a load, right? So I can drive. So it's a very different market, but that's a leading economic indicator. So what are you seeing in the economy going forward?
One of my worries from the reading I've been doing, and an example, because Elon Musk is a pretty popular guy, one of the wealthiest guys on the planet, and he makes news all the time. But when he bought Twitter, what was interesting is he quit paying the rent. He's not the only one doing so. And further reading is seeing how much trouble about companies are leaving. And an example in New Orleans, huge shipping business is there as well, and they're leaving downtown New Orleans, going to the suburbs. So you've got all this real estate being vacated, or they're not paying the rent. And you've got REITs that are built with these commercial properties, whether it's the shopping centers or office buildings. And it is a serious concern about those REITs staying viable, where they're promising to have you 7 to 8% cash flow. Are they going to continue to meet that and have liquidity?
Well, so one, we always tell people be careful of the guy, the broker, right? So we are not a broker. We work as a fiduciary, what's called a registered investment advisor. So we don't sell commission based security products, but these REITs, the ones, and when they're publicly traded, which we do use in portfolios, we get exposure to real estate, but we can see the financials because they're publicly traded. They have to report. But these non-traded REITs are really the scary ones. These are packaged up and sold typically through broker dealers, and they're a high commission product. The guy gets paid to make it, and then exactly they promise these 7-8% dividends, and they're going to pay the broker dealer a 10 to 12% commission or takedown to offer the product. So they're behind 20% day one, and then you talk about the headwinds that the real estate and the tenants they have in these buildings are facing right now. Those things are going to get, and they got hammered already, but there could be a lot further to go. That leads us to a secondary problem, the bank run we've been talking about on our show for the last couple weeks. Why are these regional banks having a problem? Well, guess who owns the notes on those buildings? It's a lot of these banks, and those buildings are not going to be worth it. We just had a building. You were talking about Elon Musk out there in San Francisco. Stop paying rent on his building. There's a building. I think it's 2 buildings down from Tesla headquarters. Don't hold me to that, but it was worth $300 million a year ago, at least appraised value, and it just sold for $60 million, and there's nobody in it.
Yeah, they're having trouble giving away the properties then in that case, because 300 million and then sells
Well,
for
well,
60. That's got to be absorbed somewhere.
Well, so just think about the maintenance just to keep the building running properly, right? You got to have havoc, AC, maintenance, cleaning costs, and then property taxes on the building, whether you have tenants or not. You're going to have a pretty large expense, 5 to 8% on the value of that building. So even if they bought it at 60 million, they're probably going to be spending $6 to $8 million a year at a bare minimum. And if they're not collecting any rent, how are they going to pay you if that's part of a portfolio? How are they going to pay you an 8% dividend on that?
Yeah, exactly. And I think that's why your listeners, if they have tradable REITs, probably should reach out to you to get a second opinion. If you have non-tradable REITs, you need to find out what the liquidity is. Can you get out of that?
Yeah,
And
can you exit them? Yeah.
and another warning, 'cause I always kind of say this about non-tradable REITs, is when somebody talks with you about getting into that, I say run.
So yeah, so that is a concern because you've got all these office spaces. Now, what's interesting here in Omaha, right? And this is your first trip into Omaha, right?
Yep.
So when you land here at Ep.18 Field, our airport, which is right on the border with Iowa, right on the Missouri River there, and as you drive out here, kind of where we are, midway out to the suburbs, we're at 137th, we're 137 blocks basically from the river, right? We have our downtown, we have our midtown, and then out here we have tons of office space coming online. There's brand new office buildings across the street, and they're being built. And there's one right down the road from the hotel we've got you staying in. It's empty, not a single tenant. It's been built for 2 years, and they still don't have a single tenant in there. So it makes you wonder. And this is a pretty viable economy here. We're the number one city, by the way, if you didn't know, Omaha, to weather recessions because we have such a diverse economy. We're not tied to any one industry. Like New Orleans, shipping obviously is a massive industry for
Shipping,
your
oil,
yep,
yeah.
and oil, et cetera. Where here We're so well diversified. Of course, we have the Oracle of Omaha here, Warren Buffett, just down the street. But we have banking industries very big here. We have insurance industries very big. We're the number one stake, which you're going to find out tonight, by the way, a place to get a stake in the country. And so we have we have great universities here. We have wonderful medical facilities here with UNMC, et cetera. And then we have Offutt Air Force Base. So we've got such a nice, diverse economy. We weather the storm better than most cities for sure. But even places like this, we're seeing real estate go backwards. I mean, even that place where I live, I talked about a couple weeks ago, a house on my street, which is a middle income neighborhood. It took a 10% drop in the price to get the house sold. And people are not prepared for what's going to happen in real estate, in particular commercial real estate, like that example we talked about. So how bad do you think it's going to get, and how long do you think it's going to last?
I was just thinking about that. It is going to it is going to create opportunities, but then you've got to have a vision of how long will it take to turn this around. I think it's up to a decade for this coming back around. Some areas are not going to be impacted as bad. Some others, especially the larger cities, the more dense areas, there's going to be more impact from that.
Well, there are buildings in New York City that are basically have less than 5% occupancy now, and I forget. There's a gentleman on Twitter this morning actually saw a reference to that, and they're almost scared to go tell the banks just how bad it's going to be, and which is why I think the bank runs are going to continue for these regional banks that hold the notes on these buildings. It's just it goes through a reset, right? The Bible, we call it a jubilee. Every once in a while, things get out of control and prices have to reset. And our commercial real estate market is absolutely, especially in office space, going to go through that. Now, the other area that I think is in trouble in real commercial real estate is basically the strip malls, right? So,
Yes.
the strip malls, if you've got like a Hy-Vee here or a Publix in Florida or whatever your grocery store chain is that anchors a strip mall, that's that's how you want to be in there. I used to own restaurants, pizza places, and we were always in like Winn-Dixie's or Publix supermarkets in the South. And because the foot traffic they brought us was guaranteed business. Well, if that tenant moves out, that real estate's worth 10 cents on the dollar typically. And we're going to see some of those strip malls that don't even have major tenants that went through this last expansion, got built. They're going to be in trouble. So it doesn't mean all real estate's bad, because I think you pointed out something that's really important, Greg. Opportunity. With every
Yep.
crisis comes an amazing amount of opportunity, and if you understand where to look, we still need to build housing in this country. We have housing shortfall. Multifamily is probably going to be pretty strong. There's certainly going to be some corrections in there for a long time. 55 plus communities are growing fast, and those are areas, and then just areas and states that are getting this population migration. We're seeing, during COVID, we saw that people had the freedom to move if they could work remotely, and magically they started to move to states that had better tax lives to live there. So Florida and Texas were the two major beneficiaries of this mass migration. So those cities that they left, if you're the owner of that building, that's probably not a good thing long term.
In a way, it seems like Florida's kind of filling up, or have priced themselves out of, say, the middle America retirees, and that they're going to start migrating
Yeah, so they're
westward
choosing
from
other
there.
places,
Yeah.
absolutely. And we talked about tax analysis of other states. So according to my research, the number one state to live in America for tax liability is Tennessee, and this takes into account income tax, property tax, sales tax, plus all the fees and registration things you pay. Like here, if you're in Omaha city limits, we have a wheel tax. It's it's just ridiculous. Another way to get money out of you. So our property taxes, I've already shared with you, are really outrageous here. Where in Florida, I've owned homes, and a $500,000 Florida home, you might pay $3 or $4 grand in property taxes. Here, it's going to be 3 times that, and so it's really a problem here. But which is one of the strategies we offer for our clients, is to show you how to potentially eliminate that, by the way, throughout your retirement. So anyway, listen, we're out of time. I appreciate you just stepping in and jumping on the show with me this week. You've been a radio veteran for a long time. Thank you so much for your wisdom and dropping in with us.
Thanks for having me, David. Appreciate it.
Absolutely. All right, Chip, we're out of time here. What do we got next?
Up next, you have questions. David Brooks has answers. Q&A is next on Retire Smart with David Brooks. Welcome back to Retire Smart with David Brooks. I'm Chip Maxwell. Into the Q&A we go. First question, David, is about qualification for dealing with Retire Smart. And the question is, I notice that most financial planning firms have minimum requirements for clients. Is that true at Retire Smart?
So by the question, I'm assuming they're talking about maybe a minimum investment level, et cetera. So while we have the right to refuse anyone as a client, officially we don't have an actual account minimum, but we primarily work with the people that have invested at least 250,000 or so for their retirement. Now, let's talk about the reason why firms would have minimums. And there's firms with a lot higher minimums. I don't meet with clients at that level anymore. I haven't in a long time, and that's just because we have to be efficacious with our time. We want time value of money for not only our employees but for our clients to get the best bang for their buck. So most firms, Chip, first of all, focus only and solely on the investments themselves. So they charge some sort of fee, whether you're buying commission-based products from a broker or you're working with a fee-based advisor who's charging you some sort of fee on the assets that they manage. They're called assets under management, and there's usually some kind of annual fee that will be billed on those assets. Well, that fee has to hit a certain minimum to pay for the advisor's time, his office space, et cetera, right? So that it just makes sense economically. So we primarily work with, as I said, people that have saved at least $250,000 or more. Doesn't mean we have not we've turned away every client below that if they're serious and want help, but there is a minimum fee structure that has to be put in place. You have to run a profitable business. Now, when you go to these firms, the other thing is it's not just the minimum investment number that you should look at. It's also what sort of work do they do for the fees that they charge. And you should ask these questions when interviewing any financial advisor, in my opinion, because most folks, as I said, they only focus on, most advisors, just the investments. And that's one piece of 5 critical areas when it comes to actual retirement planning. You need to have what we call holistic plans. Got to look at everything. Got to look at your income sources. There's income planning. Got to look at your medical and healthcare expenditures. So our advisors here spend a lot of time on things that are not the investments, right? That's about
Well, and
20%
of
of
course,
the work.
tax planning,
Oh,
which
absolutely, the tax
is
planning,
our
et cetera.
focus this week.
So, so we don't have a hard minimum, but I always tell people we primarily work with people about $250,000, and we have like I said, over a dozen advisors on the team now, and we try to place you with the appropriate advisor for the level of investments or sophistication that your plan would need. Whether it's tax planning, asset sales, et cetera, there's lots of different ways that help people understand if it makes sense to work. But there's never any pressure here at Retire Smart. We don't, we don't, oh, you got to sign up today. We basically want to help people that want help. And so our process, the report card, as we talk about, is just an initial 30,000-foot overview. It's complimentary. We don't charge anybody to go through it. And then if we just ask you, do you want help with that? And if you want to engage our firm, we'll tell you what that looks like. But
you decide, yeah.
But it's a great question, and people should always ask those questions of the firms they're working with.
Well, and it's also for the benefit of the potential client. David, we don't want to collect a fee from someone if we're not going to do them any good, if we're not going to provide any benefit. And the strategies really only provide benefit if you, as you say, roughly 250,000 and up. So we're not going to collect a fee from you if we're not really doing you any good as well. So that there's a mutual benefit to it. But definitely, if there's any question in your mind, questioner or any listener, give us a call, 402-369-7777, and we'll sort through it. David, here's a question about NASDAQ versus Dow. I saw a headline that said the NASDAQ exchange was leading the Dow by the biggest margin since 1991. I'm not invested in NASDAQ. Am I missing a great opportunity?
So you need to understand when we're talking about these different indices, what it means. So there are stocks that are in the Dow that are also in the NASDAQ. So you may not be missing out, okay? So
what would be an example?
All right, so Apple. Let's give you an example.
Okay.
Apple, right? So basically one of the largest companies out there, right? It is one of the Dow 30 currently. So the Dow Industrial Average is only 30 companies that are it's just an index to try and represent the economy in America. So we don't look at the Dow that often, frankly. It's one that the news report is because it's the oldest, all right?
Yeah.
More relevant index in my mind is the S&P 500, right?
Okay.
So that's 500 basically largest companies in America. So a much broader swath of the economy to judge. And then the NASDAQ is a heavily tech-based index. It's not all tech, but it's primary. It's just another exchange where you can trade. So you can trade on the New York Stock Exchange, or you can trade on the NASDAQ or the American Stock Exchange. So the Dow Jones Industrial Average and the S&P 500 are indexes that you track. The NASDAQ is an exchange. All right. Now, the NASDAQ has basically, there's an ETF you can track. It's called QQQ. Those are the ticker letters. That tracks basically the top 100 NASDAQ stocks, which is mainly tech companies, Amazon, Apple, right? All these companies that, And so companies can list on the NASDAQ, but still be part of the S&P 500 and still be part of the Dow Jones Industrial Average. So you need to make sure you have an apples to apples understanding of what the question that you're asking. But yes, all those indices are tracked and those are reported on the news. But the Nasdaq is more volatile because of the tech stocks. And this year, the reason for that big separation since 1991 is because 5 stocks are leading the way. They're over 100% of the return of the S&P 500 right now.
Apple, Microsoft.
So it's what we call magma now. So it's Microsoft, Apple,
Google.
Alphabet, which is Google, right?
Okay, Alphabet.
And Meta, right, which is Facebook, right?
What's Facebook? Okay.
So these are the stocks that have carried the way. I mean, Meta's up like, I don't know, 45, 50% since its October lows. Can it sustain that? I don't know. I would tell you Microsoft has been on a bit of a tear, but that run may be at the end here. And the reason, and the funny thing is Microsoft, we talked about it, they just said, all right, we're done with our layoffs back in January. Oh, they just announced another several thousand people got fired this week, literally.
Wow.
So
Yeah.
the layoffs are continuing. But anyway, to your point, no, you may not necessarily be missing out, but also the biggest thing I would tell that questioner is understand your risk capacity and tolerance before you just go chasing returns. And that's why working with a fiduciary-based professional can help.
Well, and that is part of the report card analysis, risk management. That's the R, risk management in a smart plan. David, here's a question about the housing market. My husband and I are in our early 70s and retired. Our home is valued at about $400,000. We'd like to downsize. Is now the time to make our move?
Well, it depends where you live, right? So if you're local to us here in Omaha, downsizing usually means upspending, unfortunately, right? Because
That's true. Yeah.
we
in the market of the last few
here,
years.
most of the suburbs that were built 30 years ago, you had the split levels really popular here. You kind of walk in and go up or down the steps type of thing. And then a lot of folks live in what we call, like I do, I live in what we call a 2-story walkout. So basically I have 2 stories plus a walkout basement, right? And so that's a lot of house to upkeep, and we're empty nesters now. So, and my wife talks about, man, this is a lot, 5,000 square feet to clean, I'm like, hire somebody. But anyway, but it's a reality. So, and dealing with steps. And so one of the things a lot of our clients talk about is we'd like to move into a ranch style house, a single story house. Problem is that's not what was built here. So now they are coming online. Builders are building them, but because they're building them at today's prices and today's, supply chain prices, you're usually spending up to $100,000 or more to downsize
To get less house.
to get less
Yeah.
house. And
Yeah.
is that really a financially smart move? I can't say, but if it's a lifestyle move, hey, have at it if that's what you really desire. I can tell you, my wife and I talk about all the time, boy, it'd be kind of nice to have that maintenance-free lifestyle. So we talk about maybe a high-rise condo or something and somebody
Yeah.
else do all the snow removal. Who knows, because I go out there and shovel my snow. I still mow my yard sometimes, I don't mind doing the work, but it's a lot
Some
to
empty
upkeep.
nesters gravitate to downtown Omaha and some of the lofts and things down
Yeah,
there.
and we're seeing more of that construction going on right now. So there are opportunities. I would just tell you, make sure you look at it not only from a lifestyle standpoint, look at it from an economic standpoint. And economically, it may not make sense. So asking to quickly get to this point, is it the time now? Well, if you're carrying a mortgage, it may not be, because you're going to have to go way up in payment if you have a mortgage that you locked in 3-5 years ago at sub 3.5%, and today you're going to go get a mortgage at almost twice that. So but there may be some buying opportunity. Depends on if you can afford to make the purchase or wait. And there's a lot of factors. That's all the things we cover in our planning process.
Well, again, the report card, all roads lead to the report card, right? See, the A in a smart plan is advanced planning for all aspects of your life in retirement. That would include a decision like this, but it's not a one-size-fits-all answer. We'd love to visit with you about it. 402-369-7777 for a complimentary report card. 402-369-7777. Up next, where are the best and worst places in America to live and retire? We'll look at some recent studies next on Retire Smart with David Brooks. Welcome back to Retire Smart with David Brooks. I'm Chip Maxwell. Well, David, you sent me a story from Zero Hedge about ghost towns. And when I see ghost town, I think of tumbleweeds blowing through some abandoned desert town in Arizona or something. That's not what we're talking about here. We're talking about the heart, the core of some of the most urbanized areas of America. Here's the headline from Zero Hedge. New York, San Francisco office buildings are absolute ghost towns. You and Gregory in the second segment were alluding to some of this. What is happening in the real estate market?
Well, so as companies were trying to call workers back from this remote working stuff in the last couple of years from the pandemic. There's been a little bit of resistance, right? And so people had relocated out of center cities, especially heavier populated cities like Los Angeles, Chicago, New York, San Francisco, and so they moved elsewhere, and so they're renting smaller offices for their clients, but so they're having to basically give up office space in these gigantic, 80, 100-story buildings in these major downtowns. And now you're seeing a ghost town. And we briefly talked about it earlier. There's an empty building in San Francisco that sold for $60 million that was last year worth $300 million. And so there's going to be some transitioning. And now one of the unique things is there'll be some investment opportunity. And Greg talked about that earlier in the show where somebody may have the opportunity. It may take a while, but you could see some of those buildings could be turned into condos instead of office space in major cities if people move back in. But to give you an example, the article in Zero Hedge cited in New York City alone, you could take the empty office space, you could fit 26 entire Empire State Buildings. If you've ever been to New York and gone to the Empire State Building, it's quite large, right? You could fit that entire building, 26 of those. That's how much empty office space is in Manhattan right now.
That is a ghost town within the city.
So to Greg's point earlier, some of these banks that, I was talking about the banks that hold the mortgages on them, or the REITs that are expecting to collect that's real estate investment trust, collect the rent and then pay that as dividends to their investors. That may be a problem.
My brain is still stuck on those two numbers you just threw out. You said a $300 million building went for, did you say $60 million?
$60 million.
That's 20 cents on the dollar, isn't it?
Yeah, absolutely.
Oh, my goodness.
And
this is unsustainable.
Well, now let's face it. You shouldn't be heavily as a retail investor, as a retiree. You shouldn't have more than 5% of your holdings in real estate anyway, right? As far as a portfolio that would own something like this. So if you've been working with somebody who's set up a portfolio, the damage, so to speak, should be minimal. But here's the problem, and we talked about it briefly with Mr. Ricks earlier on the show. Is these brokers sell these people this, you're going to get 7-8% dividend on this stuff. And they sell these non-traded products. These are not liquid. They don't trade on exchange. You can't just get out of them. And you don't know the value until they print another statement. And they're only required to do that so often. So people buy these, and typically they were sold at like $10 a share. And all of a sudden they wake up, what do you mean it's $1.70? And it's $2.30. And yeah, it's that 20 or 30 cents on the dollar. And that happens. So, but I got a 7% dividend. Well, I don't think that makes up for 80% of loss of principal.
You lost on that deal.
So if you unfortunately hold those, yes, you should find out what the liquidity provisions are. Usually you can only ask to get out of those things quarterly or annually. You need to see what that looks like. And basically just understand the risk that you're taking in those type of investments is one of the R in our smart plan. So that's critical.
Well, now, if I was tracking what you and Gregory were saying, isn't there also a connection to the the continuing spooky phenomenon of the bank runs?
Well, yeah, because there are banks. Somebody's holds the mortgages on these. These are not typically cash deals, right? Although I think that Twitter one or the $60 million. I think somebody paid $60 million cash for that, which is why they got the deal. But that was somebody making a long-term play and long-term bet and buying stuff on the cheap. And exactly 7-8 years from now, if that building's worth $100 million, would you take 40%? Sure. So but the banks, somebody owns the mortgages on these. And if those mortgages go under, they have to foreclose the building, right? If they have a loan to value of say 70% on that building, so let's take a $100 million building and there's $70 million in mortgages on it, and they foreclose on it, and they can only sell it for $40 million, being generous at 40% on the dollar, then the bank has to write off $30 million, right? How's that going to help the bank's stock price? Right. And so the beatings will continue until morale improves, Chip. I mean, the real estate market is really in commercial real estate specific to office space in large cities is really in trouble.
All right. Well, speaking of improving morale, let's try to bring a little sunlight into the conversation here down the home stretch of our show. Fox Business headline, David, best U.S. cities to live in. This is according to a study done by U.S. News and World Report. I was surprised to see a city in the north. It's usually a southern city, but Green Bay, Wisconsin came in at number one. Were you surprised by that?
I actually was. I was really surprised by that. And, number two, we actually have one of the advisors visiting in has an office in Huntsville, Alabama.
That
That
was
came in
number
at number
2.
2, and actually,
Yeah.
that's where my brother-in-law, he's a news anchor there in Huntsville, Alabama, and that came in at number 2. And I can understand that because a little warmer climate than Green Bay,
Yeah.
but it had to do with affordability, access to things you want to do, culture, et cetera, healthcare, et cetera, and so people are pretty happy. Now, what's interesting too is I sent you an article on the top states to live in, right? So we
Yes.
talk about the top cities, and a lot of people would think about, we've talked about on the show, the migration to Florida and Texas.
I was expecting to see Florida come in number 1, but it wasn't.
Well, and Gregory Ricks brought up early in the show, right? Florida's getting a little expensive now
Yeah.
because of such mass
That's
movement for
right.
3 years now, 1,000 people a day or whatever it is, and it's getting to where it's not quite as affordable. So the number 1 state happens to be where my brother lives and
We're
where
gonna
I went
hear-
to high school and we used to have our
We're going to
farm.
hear from Lou about this in
Yeah.
your childhood state, old Virginia.
Yeah.
Virginia.
Virginia.
So why did Virginia place number 1?
Well, it was the overall. So Virginia's got mild climate, right? So it's a wonderful place. You have all the culture activities you want, professional sports. You have access to. By the way, if you're not a fan of Northern Virginia and the museums like the Smithsonian, if you've never been, you took your family actually a couple of years ago on
Yes.
that trip.
Yeah.
It's an amazing experience to me. So it's all things factored in, and Virginia is actually ranked really well in healthcare and affordability relative to the other states that we talked about. So it takes in a myriad of factors in there. But yeah, it was surprising. Now, Florida, my other old home state,
Yeah.
did come in still at number 2, right?
Right.
But it was not number 1, and affordability was the number 1 reason it fell in the rankings there.
That was Wallet Hub. It's actually a CNBC headline about the best states in which to retire. David, let me go back to the cities for a moment. So the Raleigh-Durham Metroplex there in North Carolina. Boulder, number 4, often comes in a lot. Sarasota and Naples, 5 and 6. There were a couple Florida entries there. Portland, I have a son that lives in Portland, Oregon, and there are great things about living there, but it's so wild out there with Antifa and the rest of it. I was surprised to see it in the top 10. Charlotte gets a lot of buzz, number 8. Colorado Springs, number 9. Fayetteville, Arkansas, number 10. But I was looking for our cities, 19. Des Moines came in at 19. Lincoln, 32. Omaha, 46. San Francisco was 45. We were behind D.C. and San Francisco. I don't know. That got my back up a little bit.
Well, our tax situation here
Okay.
is
All right.
one of the reasons, the tax burden, and then our weather. So we don't have favorable weather, at least the way they do the metrics here. Like, it's beautiful out this week, but
Yeah.
and our tax burden is what crimps it. And we hear it from retirees all the time.
That's true.
But before you go and take something like that and go, I can't retire here. I'm out of here. I'm tired of paying these taxes. Factor in all the expenses of retirement. As we've talked about on the show, taxes is something we're very passionate about, helping you understand how to save. And just so you know, we can potentially eliminate your property taxes in retirement with one of our strategies. But healthcare is the second biggest expense. And you need to make sure before you decide where you're going, you factor in all the things that would matter when you're going to change places and try to retire. So if you're thinking about relocating, think it through. Don't just go on one decision like taxes is the reason I'm moving to Florida or Texas or whatever it may be.
Well, I'll tell you what, though, we better not sleep on it in Nebraska, because that top 10 list of best states in which to retire: Virginia, Florida, Colorado, Wyoming, Delaware, New Hampshire, South Dakota, Minnesota,
A lot of
Idaho,
border states
North
here.
Dakota, a lot of our company, a lot of our surrounding states. So we
So
better not
maybe
be
we
on
can get our
autopilot.
legislature to take some action.
Exactly.
Although there's one legislator I don't think will take any action. She said she's going to burn it down or something because she didn't get one of her bills
Don't
through. But
get me
anyway,
started on that. I was surprised that Tennessee. I heard you and Gregory talking about Tennessee earlier in the show and its favorable tax climate. I thought I'd see Tennessee in that top 10, but it didn't
well,
rate.
the pricing too, like Nashville's become extremely
Ah,
popular.
okay. So the same problem.
Yep,
Florida might
yep,
be
same part
a
of
victim
Florida.
of its
Yeah,
success.
exactly.
Okay.
And all these things work out over time. But anyway, the bottom line is, before you step into retirement, if you're thinking of anything major shifts, lifestyle changes, moving, this should all be part of a good holistic retirement plan, and that's what our report card will do for you. I know we're out of time this week, Chip.
Well, that's all right. A perfect segue. Again, all roads lead to the report card. Now, if you want to dip a toe in the water, we have a tax planning guide. You hear it advertised during the show. Now, actually, dip a toe in the water. It's a 32-page document full of charts and graphs and facts, but that'll get you launched. But if you want to take the full plunge, get the report card. Comprehensive review of your entire financial situation. There's no charge. It's complimentary, no obligation. And we'll look at your whole situation. Maybe you're in good shape. Maybe you need to make a few changes. Now is the time to find out with the complimentary report card. To get the report card or a tax planning guide, that's 402 369 7777. 402 369 7777. Last call for the ABCs of Medicare, Wednesday night, May 24th, 6:30 p.m., right here in the Midwest Learning Center at Retire Smart. We need you to register if you're going to come. No charge, but we need you to register. 402 369 7777. And finally, mark down that patriotic parade and concert. We'll talk a little bit more about that next week, but get it on your calendar for Memorial Day weekend, Saturday morning, May 27th, 10 a.m. downtown at the Leahy Mall. David, bring us home.
Hey, listen, we had over 100 folks come by and use our Shred Day services this week. So thanks to those folks for doing that. We're glad to provide that service. Get outside, enjoy this gorgeous weather before it gets too hot. We'll talk to you next week. Have a blessed week.
Thank you for listening to Retire Smart with David Brooks. I'm Chip Maxwell. For David Brooks and the entire team at Retire Smart, have a great week. Gregory Ricks is not a client and was not compensated for his appearance.